I'm in Omaha.
Good morning, City of Lakes Rotary. Good to see you here this morning, bright and early. Why don't we rise and say the Pledge of Allegiance? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. And the four-way test and the things we think, say, and do. 1, is it the truth? 2, is it fair to all concerned? 3, will it build goodwill and better friendships? And 4, will it be beneficial to all concerned? All right, our reflection today is Sean Irwin, who is online. Sean.
Good morning, everyone.
Morning.
Really appreciate everyone gathering together. I'm actually out in Tucson, Arizona, seeing my mother. So thrilled to be out here. We were lucky enough to have a wedding in December without much super spreader event. We had no real problems with it, so we're happy about that. And really, as things are ramping up psychologically, I was thinking a lot about taking a breath. We have this resolution time, budgeting time, planning time, all this stuff that revolves sort of around a day and a date. And it's a construct that we invent in our minds. It's not something that really is relevant to, this long life that we live. And whether that breath means being meditative, in my hyperness, I'm not the best meditator in the world, or action, right? Whether it is going for a walk or simply a swim or something that's more active that brings our temperature down. I hope everyone can do that as we are navigating through sometimes. And then Sharon's going to ramp us up and talk about money, which is not emotional at all. So we got nothing to worry about there either. So really hope everybody together joins together with their friends, their loved ones, obviously our fellow Rotarians, and takes that symbolic breath or actual breath to really center themselves and enjoy each day that we have together. So thanks, everybody.
Thank you, Sean. All right, I think the Rooters online are going to do this song. I was thinking we'd sing along with you, but I'm not sure that will work. So who from the Rooters is going to kick us off today?
I think Sean, you're going to kick us off, aren't you? You're going to do verse. You do verse 1. Ellen, do verse 2. I'll do the bridge. And Sean, why don't you repeat verse 3?
Okay, I got to get the words here somehow. Okay, I got it. We're in the money. We're in the money. We've got a lot of what it takes to get along.
We're in the money. The sky is sunny. Oh, man, depression, you are through. You done us wrong.
We always see the upside about our finances today. And when we see our neighbors, we can help them in the Rotary way.
We're in the money. We're in the money. We got a lot of what it takes to get along.
Thank you, Rooters. Sharon, that I guess was for you today. We're in the money. We're hoping we're in the money. We'll see what happens here. Are there any guests or visiting Rotarians online? All right. If there is anybody online, you might want to unmute and introduce yourself. But looks like we got all members. All right. Announcements. Ellen, online, you have an announcement this morning.
Ah, yes, I do. It's been a while since you all have heard from me about our Lake Street project. I wanted you to know that as we come into the new year, Suzanne Cochutver of the Excelsior Morning Club, who originated this project, called a meeting last week of leaders of the project from each of the participating clubs. I think we're somewhere between 6 and 9 clubs involved, including Sharon Bloodworth's club, District Number 9. The project is, we hope, going to go forward, and Rob Scarlett and I are serving on a committee to draft a business, what we're calling a business model, but it's a business model for the project itself as we go forward. As you know, the business with which our club was matched was not able to make it. So I'm not sure yet whether going forward will involve assignment of a new business to our club, or a matching of a new business with our club, or might involve our sharing some of our expertises, because we are a large club with experts in so many fields, where smaller clubs might need someone from our club. So that the only update is keep the name in mind and hold on for a more substantive update later. Thank you.
Very good. Thank you, Ellen. I know Gail Noakes has an announcement here. We're going to get you a microphone.
Thank you. Morning, everyone. Peer group is tomorrow morning. We have an interesting topic, particularly this time, and it's planning and managing a extended leave from your business. So interesting topic. Sean Irwin's going to be leading that conversation. So if you'd like to join us and you don't have the link, give me a shout, gail@gailnoakes.com. Thanks.
Great. Thank you, Gail. Chris Morris has an announcement.
Thanks, Ross. The vocational committee is coordinating once again this year mock interviews at Dunwoody Institute. It's something we've done for, I don't know, many years. The plan for this year is to do them in person on February 2nd, 4:30 to 6 p.m. at Dunwoody. It's possible that could change. Last year, I think we did it virtually. But for newer members, it's a fun project. You're basically meeting with first year, second year students at Dunwoody. So, 19-year-old kids who are looking to get internships, who haven't interviewed for jobs before, and they come in and they provide you their resume, and you act like an employer who's interviewing them for 15 minutes or so. It's really helpful. The kids are very thankful. I will try to send out I've already got a bunch of signups from the vocational committee, but I'll try to get an email out to the club and with my email address and contact information, so you could let me know if you are able to come, or just let me know after the meeting today. Thanks a lot. February 2nd.
Thanks, Chris. That is really a great event. I think Bill Jackson online has an announcement. Bill. Oh, we can't hear you yet, Bill. Sorry.
Yeah, I'm on my phone, so thank you. Yeah, I'm inviting everybody to the International Service Committee meeting. They'll be meeting Thursday by Zoom at 5:30. I sent out a link to our members and other interested people, but if you didn't get it, just contact me and I'll send you the link for the meeting. Hope you can join us. Thank you.
Thanks, Bill. Any other announcements that I missed? All right, great. Thank you all. Well, it is my pleasure to introduce our day chair today, Kelly Marquardt. Kelly has worked in the high performance computing technology development for more than 25 years. She spent most of her career in high performance computing at Cray Inc. where she held a variety of engineering and leadership roles, including leading software and hardware development teams and leading custom development programs for government customers. Most recently, she was Vice President of Strategic Customer Engagements for Cray, and in that role managed leading-edge procurements and R&D contracts. In 2021, Kelly took a new role as Vice President of Business Development for Next Silicon, a high-tech startup based in Tel Aviv that is building a computer chip accelerator for high-performance computing. Most of this, I don't understand what it is exactly, but okay. In this role, she leads the business development applications and support teams worldwide. Next Silicon is focused on building technology that will revolutionize the way computing is done. Next Silicon recently opened its US headquarters in downtown Minneapolis, which I love to hear. Kelly holds a bachelor's degree in electrical engineering from the University of Wisconsin-Madison and a master's degree in electrical engineering from the University of Illinois, Chicago. So Kelly, thank you for being our day chair today.
Hi, everybody. I'm pleased to be able to introduce Sharon. She is the CEO of White Oaks Wealth Advisors, one of the largest independent investment advisory firms in Minnesota, wholly owned by a woman. Sharon has been widely quoted and frequently speaks at conferences and to private organizations and CEO roundtables. Born in the UK, Sharon has lived and studied in Africa, Asia, and Europe and speaks multiple languages. In 2007, she funded the rebuilding of a kindergarten in Indonesia that she named after her daughter, Sophia's Sunshine School. In 2021, she added a library to the school. She was honored as a 2013 Top Women in Business and a 2010 40 Under 40 recipient by the Minneapolis-St. Paul Business Journal. In 2019, Sharon received the Marty Baskerville Philanthropy Award from Rotary Club 9, which is awarded for lifetime achievement in philanthropy, and the Vistage Lifetime Achievement Award for leadership as a CEO. Sharon has been a member of Rotary Club 9 for 18 years and served as its president 10 years ago. She is the current District 5950 Rotary Foundation Chair and has been elected District Governor of our District 5950 for 2024-2025, following City of Lakes Rotarian Julie Grape. She co-chaired 2 distinct conferences with City of Lakes' own past president, Christine Krass. Sharon has already roped Christine in to chair her district conference. Sharon is also the current vice chair of the Minnesota Opera Board and chair of its investment committee and a member of the Minnesota CEOs Against Cancer chapter of the American Cancer Society. Welcome, Sharon.
All right, fabulous. Okay. Great. This is a secret. Just point it towards it. All right, perfect. No, I'm good. Thank you. Well, hello, everyone. I'm really pleased to be back here today. This is, if Club 9 didn't exist, then this would be my favorite club. I always feel at home here, except for it's so early in the morning. I always wonder that if I put a lineup of Jimmy Kimmel and Jimmy Fallon, whether anyone in this room would ever recognize them. Yeah, because I'm sure you're all in bed at 8:30. But yeah, no, and so this club has been so welcoming to me. Even in the last couple of days, I've had lots of emails excited from your club, and my club doesn't even do that for me. So I've got to go back and let them know they've got to step it up a bit if I need to turn up there. And I'm super excited to follow Julie Grape as district governor, and so I will be her handmaid for a year as I follow her. So it's really nice. And as you know, this talk used to be given for years by Mark Thompson and Bob Klosterman. And so it's really nice that I get to follow them and stand on their shoulders to do this as well. You have great resources in your club as for financial advisors as well to be able to talk to and ask and bounce your questions off of. Mark Thompson is really a true Scion maven in our state. And incidentally, Dick Hall looks after our club's Rotary Foundation. So I'm really glad to be in really great company. So today we have lots to go through. Let's go here. If I can get the clicker to work. There we go. And so very simply, my job is just to translate things into plain English. I think economics and the markets can be very dull and boring to most people, or it can create a lot of fear. And so hopefully today you'll feel a little bit more comfortable about what's going to happen. The first lesson I wanted to say was to make sure that you remember to ignore all of the media noise. And that's the most important thing, because as you know, the media is driven by advertising, and bad news sells, and speculative things are always more exciting than something that's pretty dull. So I wanted to remind you, I showed you this about 2 years ago, where again, 1979 in Business Week, if you'd have thought that if the equities were dead and so, oh, well, I'm not going to invest in those anymore, that would have been a very sad day. And then my favorite study to always talk about is The Economist, is that between 1998 and 2016, if you looked at the cover of The Economist, every time it said that something was optimistic, if you shorted it, you'd make 7.5%. And anytime they said that something was terrible and it was pessimistic, if you went long, you actually got an 18% return the next year. So that's why it's really important to ignore things and really kind of sift through things yourself. You'll find that during COVID, we produced this for our clients, which is essentially a chart that shows you that if you're an investor back in 1970, the beginning of 1970, and if you said, every time the market falls 10%, I want out. I'm afraid I want out. I don't want to fall anymore. And then if that same investor went back in 6 months later, so 6 months again, it's 2 quarters as a recession. So you think, okay, now I feel comfortable, things are up, I'm going back in. So you can see the top line is an investor that did nothing. They put $100 in 1970, and by the end of February of 2020, that would have been worth over $16,000. But the investor that ran out every time it went down 10% and got back in 6 months later actually only made $4,000 out of that $100. So it's a huge differential if you actually get in and out of the market when you're afraid. So the most important thing is actually to close your eyes and hold on as long as you're well diversified. This was another chart that I want to show again on market timing, and it was done by JP Morgan, that shows all of the annualized returns by asset classes over the last 20 years. So you can see in the green, the S&P 500, if you're an investor, and threw your money into the S&P for 20 years, your average return would have been 7.5%. However, if you look at the orange line, the average investor over that time frame only did 2.9%. And that's recorded by Dalbar, who's done studies on the markets for decades. And they record kind of when people go in and out of mutual funds and record what they think investors' actual returns are. And that is purely because people go in when things are up. So you think, great, everything's up, I feel good. And then you go out when it's down. And then essentially you find that the recovery comes so quickly that you often miss the recovery. So that really is an important lesson to not listen to the hype, kind of hold on for the long term, and just remember this chart that it's very hard to make up mistakes that you've made. The other one point that I wanted to make before kind of we dig into more of the economics was your confidence by political affiliation. Now, our clients are 50-50, and sometimes it's 50-50, even between marriages. But what your sense is that I know that when there's a Republican president in charge, all of our Democrat clients come in and they're really worried about the future, and they think it's terrible, and look what's happening, and everything's going to crash. And then the reverse also happens. But what you find is what this chart shows you is a percentage of Republicans and Democrats who rate national economic conditions as excellent or good. The red is a Republican, the blue is a Democrat, and then the gray is the combination of all of them. And so if you notice that they actually align with when you actually have a president of your own party. So whenever your party's in, you're awfully optimistic, and when your party's not in, you're not. Well, the sad thing is that generally the market does well under all conditions because businesses will always find a way to make money. And so again, also putting the political things apart. I know during the Trump years, our Democrat clients were like, oh, there's just no way that the market's terrible. We're insulting China. It's just going to be awful. Well, the fact was that his policies were very stimulative. Lots of money got delivered out into the economy, which again, then creates a money party and everybody's celebrating and times are good. And this is what's happened again under Biden, because we've been in the middle of a crisis. So much money has flowed out to people's hands and companies' hands that everything does really well. So my advice to you as well is also ignore all the politics of the time and just kind of try and have a look at what the policies are that underlie it. And then lastly, for those who like to keep their cash in the mattress, because there's like, oh, I hate all of them, everything that's in the future, I'm just going to put my money in cash. Well, this is a horrible chart to show you that that's not a good idea either. What this chart shows you is income that you earn having 100,000 in savings accounts. So if you look at 2021, your average savings account, if you had 100,000 in it, you'd only earn $70 for the year. But however, if you look at the blue line, which is just right at the top, you'd actually need to have earned $4,960 to actually keep up with inflation. So by keeping your money in the mattress, you're actually moving backwards and you're losing money. And then you can see a couple of the other ones. The green line shows you the income that you'd need in that savings account to beat education inflation or to beat medical care inflation, which is the purple. So again, kind of long-term holdings in cash when you're in an inflationary environment. Also, you don't realize that you might think you're being safe, but you're actually moving backwards and throwing money out of the window at the same time. Oopsie daisy. So going back. Oh, can you take me back, please? Thank you. My forward works, but the back's not so good. Thank you. So, so I showed this to clients at the beginning of kind of 2021, where we were so hopeful after 2020 ended that 2021 was going to be a marvelous year. And however, there was a lot of issues with vaccine distribution and still a lot of kind of political and kind of social strife and unhappiness. And so 2021 was not a great year that followed 2020. However, for the economy and the market, it was a wonderful year. And so today I'm here to talk to you about, well, what's in line for us in 2022, hopefully something better than what we saw last year. So last year, again, beautiful, beautiful year for the market. You can see the S&P 500 was up 26.9%. Kind of bonds had some struggles there. And if you're in Bitcoin, then you know, you had a great year, but I'll talk about that one at the end. We get a lot of questions on Bitcoin if we have time. So it's just a really, really lovely year for the market, which of course, after most crises, you're rebuilding and there's optimism. And so it's always wonderful to have an up after a kind of a very miserable year as well. It was also an amazing year for the economy as well. This shows we get the fourth quarter GDP comes in at the end of January now, but the estimates for this past quarter by the Atlanta Fed is about 6.8%, and it's a little bit lower. The blue line shows you kind of what the kind of average forecast by the blue chip consensus are, and then the Fed's on top of that. So it's huge. And so if we look at this line, you can see that, you know, this is the trend growth over time. You can see 20, our big dip for COVID, and then we're back up. And so, you know, when we combine this upcoming, well, this last quarter in those numbers, we're pretty much back on that blue line, which means essentially that we're back on the same trajectory should COVID have never happened. So the economy has come back very, very quickly. And very, very positively, despite all of the kind of the personal angst around last year as well. But you can see that again on a personal perspective, it was just a really horrible, horrible year for COVID and for personal disruption, having to work from home and being separated from your families and less travel. One of the good things that does show in this chart, though, is that the blue line shows confirmed cases. So you can see the kind of the Delta prior and then the Omicron now at the end of the year. But the gray line shows fatalities. So even though we've got a horrific amount of cases, the fatalities are still fairly low. So there is some cause for optimism, but I'll leave that to the medical experts to pontificate on that. But it is a very sad time where you can see that in last year in 2021, the COVID deaths worldwide actually exceeded all of the deaths in 2020 for TB, HIV, AIDS, and malaria, which is just absolutely unbelievable. Incidentally, I had malaria when I was a kid, growing up in Africa, and my dad 2 weeks ago just got over dengue fever. So, regular diseases carry on despite everything. So you don't need to read this because it's very, very small, but this is an economist's view of they aggregate all of the betting houses, sort of predict it and markets on what people actually believe is going to happen in 2022. Above the line, they say it's very likely to happen. The middle line is like, well, it's kind of even likelihood, and then the bottom one is unlikely. So over the next couple of slides, we're going to go through and kind of do a little bit of a deeper dive into some of these. Some of the implied chances of this happening in 2022. There's a view that it's very, very likely that Republicans will take control of the House of Representatives. That's actually an 82% likelihood that's predicted by, again, all the betting houses. And then also that inflation in America exceeds 4% in 2022. They go through world news, COVID news, politics, business and economics, and sports and culture. I know it's probably much more fascinating if we went through the sports and culture ones, but that's not my talk today. I always thought it's really unfair if Norway nearly always wins most of the gold medals at the Winter Olympics anyway. And I thought my architect friend that sits there has a nice Norwegian shirt on to show his support. And then some of the ones that we'll go through that sort of may or may not happen this year. Again, looking at the American economy, whether Russia will invade Ukraine, taking a look at also whether there's any military conflict between China and Taiwan, and then again looking at some of the travel things as well. So 2022, our view is that it's generally positive. There'll be slower economic growth and market returns in 2021. But it's still going to be a little bit of a bumpy ride. Now, not a roller coaster. So I don't like risk and I don't like roller coasters, but that ride looks okay. I think I could smile through it still, but it looks just slightly uncomfortable. But one of the kind of sad things that we also saw was that in a study of epidemics in 133 countries between 2001 and 2018, finds that political unrest peaks 2 years after the epidemic starts, which would make it 2022. We'll see what happens there. And my assumption is, again, is that you've got through the panic and the fear and the worry, and then you just start getting angry. But let's talk about the positives first for 2022. That, it should be a reasonable year because, again, when you come out of a crisis and go into recovery mode, generally, you have a nice kind of couple of years run. This shows you the Purchasing Managers Index, which shows kind of improving business conditions. So many businesses are asked about, again, future hiring, future buying, kind of optimism about the future, like significant purchases. And whenever it's green is great. Whenever it's yellow, kind of it's like it's a caution line. And obviously, when you're in red, it means that purchasing managers are pessimistic. We would expect some of these in December to turn a little bit yellow because of Omicron, so that has slowed things down again. You would expect them to turn green fairly shortly after that again. So again, the economy is moving, and this is across the world. So you can only see sort of Russia at the bottom is in kind of the orange phase, but most countries are kind of firmly in the green, and the US is the kind of the third section down at the top, and you can see whenever you're at 50, you turn over into the good zone, and they're up at 57. So very, very, very positive in terms of expected future returns. And I can say that oh yes, oh of course.
I'm looking at the developed countries.
Yes.
Japan sticks out like a sore thumb in the last few years, where everybody's green except them. Can you say anything about that?
Well, Japan has had a harder time overall. If you look at, and I'll show you again, even when we look at inflation, they've had kind of a negative inflationary environment as well. So it's been quite different. It's been quite different. And I'll show you in a couple of slides here. Oh, whoops. There we go. I'll get to that. So here, also with the great positives, you also have sort of great employment numbers as well. This shows you the kind of the slide down 2012, when you have sort of the declining line, it says that more people are employed. You can see the big spike for COVID in 2020, but look where we are now, down at 3.9%, which is great, absolutely great. And you hear the hard numbers that come out that talk about kind of the misery around the great quit, which some of it actually might be related to all of the mandates where people, as we read kind of with the Mayo Clinic, that sort of 700 people were laid off because of their unwillingness to get vaccines. So part of that that's hidden in the great quit is really the great push as well. But from a regular perspective, when you look at unemployment, it's really amazing. And at the bottom, I put there kind of the 50-year average is 6.3. So we're really in very, very low unemployment, which is always very, very positive when people have jobs. Also, you can see that consumer confidence is up as well. This blue line, you can see it's starting to tick up. It had a great big fall again in 2020. So the kinds of questions that they also ask consumers are about big purchases going forward. Are you going to buy that refrigerator, that kind of washing machine, things like that? And so, or do you expect conditions to be better in the future? So it means that regular people believe that they will still have jobs and they're not worried about spending in order to do that. So that is also a positive. As we know, consumers have been buying up everything as well. One of the nice things, I mean, this is probably a little bit too early to tell here, is also on the supply chain improving. You can see the line is starting to dip down, which shows that it's a faster delivery time. And that has really been a really horrible confounding issue, which is very much like a traffic jam when everything comes to a halt and then everything kind of has to move more slowly to get back into sync with everything. It was really quite remarkable of kind of what we've just experienced. And I was very, very thankful to learn during 2020, which is something that I didn't know, is I didn't actually realize how much America produces its own food. So it was just a really wonderful finding in COVID that we really didn't have to worry about kind of food supplies as well. And I think that that's probably a fear having grown up in sort of Africa and Indonesia, where you'd get food shortages fairly often. That was, I was a little bit like a squirrel at home with, plenty of things there. And my husband said, we don't need Spam. I was like, we do need Spam. It stays forever. And I actually really love Spam. And, but it was really nice to know that you didn't have to worry very much about that. And I'm not sure we even saw our French brie slow down either during the time frame. But we'll see. But it has confounded things in terms of when everyone wants the same thing, and everything is slowed down, that people are much more willing to pay higher prices for it, which then has really pushed inflation through the roof. This other chart also shows you about life getting back to normal as well. So this takes you back again pre-COVID times in February 2020. The top line is consumer or debit credit transactions. So you can see that now at the end of 2021, they're about 13% over where they started a couple of years ago. So that means that everybody's out there buying everything, and there are a lot of transactions happening. Hotel occupancy is only down 9%, which is funny because when you read the headlines, it sounds like it's much worse, but I've been doing an awful lot of traveling lately, and I can tell you the hotels have been busy, where I've been, and sort of London, Texas, Florida, they're not fully back to normal, but they're certainly much healthier. The other thing that's been really interesting with hotel occupancy as well, especially in some of the foreign nations, is that a lot of the quarantining has been forced into the hotels. When I speak to my father in Indonesia, we speak every week to talk about what the Asian markets are like, and then I'll tell him about the kind of the European and the US markets. And he said that he really feels that again, there's some sort of agreement between the government and the hotels there, because the hotels are booming because everybody's forced into them to quarantine. You can also see the, sadly, US seated diners are still down, 25%. So that's still a challenge getting back to restaurants. And then TSA traveler traffic is also down about 17%. And that's what we found is that a lot of people are traveling nationally and domestically rather, versus internationally. If you look at international travel, because of all of the issues between quarantining and testing, that's still off significantly. But if you look at the actual TSA traveler traffic, it says it's only down 17%. So you can see the huge march back we've had from February 2020, which has been just really remarkable. There's the entertainment and hospitality service areas that still have to kind of get back to where they were, but most everything else is charging on as usual. So the other thing that's also happened is that we've also had plenty of money thrown at us, and it's been a very interesting environment to watch. I don't think I've ever experienced a time in the market where I've seen so much money be thrown into people's hands and companies' hands. And all of it, again, was to make sure that we would be all right and it would be a softer landing. So in the short term, it's a very positive thing because then you don't suffer as deep a recession or as deeper kind of long-term sustained unemployment issue. But long-term, there'll be a very big price to pay ultimately. And I think I kind of mentioned this to you the last couple of times that you're here, and I can say it being a little bit overweight, is that if you are fat and your friends are fatter than you, you look great. And so we have ballooned as a country in terms of our federal debt, but everybody else has been ballooning at the same rate at the same time. And so we're in fine company. It's when you start changing from that, when some countries have to go through it and others don't, where you start seeing differences and preferences. And so as the US, we've been very, very fortunate in that, yes, we've added a lot of debt, but we've done it at the same time that others have. So we haven't suffered really being a central currency or a place of stability relative to others. If Europe really got its act together and all agreed and all moved in one direction, we'd have major competition. But thankfully, for many decades and centuries, they've been arguing and they look like they're going to continue to argue for many more. So the US benefits from that. So as a whole, when you see that the US government, again, threw a lot of money in terms of the kind of different stimulus bills that went through. If you look at companies, there is a huge amount of initial public offerings. So again, they're private and they go public. Lots of mergers and acquisitions, lots of money being thrown around. They're paying a lot of money for different companies because they're very cash rich. And there's still lots and lots of cash on the sidelines for corporations. The Federal Reserve as well has been extremely generous. Again, so far, they hadn't raised rates and they had done what they call tapering, which means essentially that they'll go out and buy lots of bonds and kind of really prop up the market there as well. And so that's been a very, very generous policy. And then again, banks as well, they've got money to spend. They've really encouraging people to kind of take out loans and spend more. And again, the consumer as a whole hasn't been tremendously hurt by it because so many extra stimulus payments went into people's hands, and so people were fairly comfortable there. So that was also the fact that we sit here now as a positive with all of that money having kind of flowing through the system, which again keeps people happy, keeps unemployment low, and keeps people spending. So very, very positive. And then even if you look at this being an unusual recession, if you look at kind of the people, this is a great chart from McKinsey that shows who had to cut back between April 2020 and April 2021 in terms of spending on food or medical spending. And so you can see, and the people who are neutral, don't show up on this chart, but you can see that 47% of people did not cut back at all. And in a usual recession, even our kind of wealthiest clients feel, oh, I shouldn't be doing as much with this, or I shouldn't be going out as much, and feel that they automatically ought to be cutting back. And so again, you can see that if you're below the 25,000 income level, 43% cut back. But you can see much fewer numbers in the higher income ranges. So people were, in fact, there was much more demand on food and other things during this environment as well. So because again, there was a lot of money floating around there. However, 2022, if you see the government as your mother and the Federal Reserve as your father, or, as the parents, this is the year that they're going to stop giving us money. If we're their teenage kid where we're like, oh, we felt very comfortable and kind of really supported, and we don't have to worry very much because they're giving us money. Well, this is really the year it stops. And that's why it'll be a little bit bumpier again, because things will get more back to normal as well. And so I'll show you that as well. So if you look at it from a government perspective, and again, we are as a company non-political. It's our job to make hay whoever we have in power. And even if you fall in love with somebody, then you're destined to have a rude awakening at least 8 years later. And so, never fall in love with one party because the next one's coming. But you can see here that there were two big shots that got through. But the third shot, the Build Back Better, which supports a lot of the kind of social programs, is probably unlikely to be. It could get passed, but in a very watered down version of what the original intent was, which might be a bit sad. And so, if you think about it from a selfish short-term perspective, as investors, anytime somebody puts a shot into the economy and pushes more money around, it's always good because it's stimulative. So it means that more people are working, there's more jobs to be had or more money to be spent. So the fact that our third shot won't be as powerful as the last two might be a very good thing for the long-term health of the country. But the short term, if you're looking at if you're looking at as an investor over the next couple of years, it won't be as it won't be as happy. So and probably the Biden administration, they're probably dead in the water at this point in terms of really getting much through now. Here. It's gone dead. Yes, please. Fabulous. And I'll tell you why. The reason why his agenda is probably dead in the water is because of the midterms that, when they're coming up, is that this chart is really rather slow. It's really rather small, but it shows you that history is really against you in the sense that most of the time the opposing party picks up quite a few of the seats during the midterms. There have only been a couple of examples. There was George W. Bush and Bill Clinton that had a positive, and then back in the 1930s, Franklin D. Roosevelt that had a positive. But other than that, every other time presidents have lost to the other party. So, and as you know, that it's really on a razor's edge in terms of the political seats. So chances are, whatever political persuasion you are, the chances are that it will probably fall to being a much more mixed environment, in which case then there won't be as much of, there won't be very much pushed through at this point. Generally, the market likes that because whenever you know that things can't get done and whether there's an impasse, so that the market doesn't like surprises. So this can be a positive for the market, even though, again, your political persuasion might think it's positive or negative, but that's most probably going to be an outcome for this year. So unlikely to have significantly more stimulus put into the market, but from there. And then this chart again shows you, when you look at the global core inflation rates, one of the negatives or the kind of the potential bumps for 2022 is really this inflation. And this is probably, I would say, the two most frequent questions I get asked are about inflation. And then the second one is Bitcoin. So one is infinitely more boring than the other. We'll just show you here. So you can see that the US is the absolute leader, and this core inflation rate takes out energy and food. And so you can see the US is the global leader in terms of inflation rates relative to the UK and the euro, and Japan has had a kind of a very different environment. And again, and also don't forget that Japan is much more insular in terms of being able to kind of access the country as well. One of the things about inflation that I'm going to go through today is doing a much deeper look into inflation so you can really understand it, because the issue with inflation is a contributing factor towards recessions. Because what happens again is that when inflation rises, then so when the cost of goods get more expensive, then the Federal Reserve tries to slow things down by raising rates, and then companies then say, oh, you know, rates are getting higher that I have to borrow for. I'm not sure if I'm going to hire more people in the future, or I'm not sure if I'm going to make that bigger purchase because now things are more expensive. And so historically, as a kind of, especially kind of the baby boomer generation and previously, I don't get the same thing in clients that are kind of more recent because they don't have any recollection of inflation. You know, if you look at the 1980s, when with your mortgage rates, sometimes you had to pay 15-16% for a mortgage, which was you're just miserable. You can't even imagine having to pay that, you know, today. So historically, inflation has really scared people, and it's a miserable thing if you have a fixed thing like a fixed pension or a fixed annuity, that it really degrades your buying power. So inflation is really important, and it is important to look at it, but it's probably going to be fairly transitory with this very high inflation, and I'll show you why. It will definitely be higher than we've experienced going forward, but there's, you know, something to think about. So first of all, we'll go through a little bit of the averages. So you'll see here, the blue line is headline CPI, consumer price index. So you could see November 2021, it was at 6.9%, and the normal 50-year average is 3.9. And then if you take your core CPI, which is the gray line, so if you take out kind of your food and your energy, then you can see it's really about 5%. And if you can take your eye and look at the November 2021 chart, and you can see energy is spiked at 33.5%. So a lot of the inflation numbers are actually coming from the energy numbers. So if we dig into that sort of a little bit deeper as well, this is just on incidental kind of, you know, to show where the Midwest is. So if the whole of the US as an average is 6.9, you can see that the Midwest is a little bit higher above the average at 7.3 in terms of the inflation that we feel here. So to back up, to kind of help you kind of go through the consumer price index components, you can see the big blue area is housing, and then the bright green is transportation, and kind of then you've got medical care and other things in there. And then energy is embedded into it. It's embedded into some of the housing with the utilities that we pay, and it's also embedded into the transportation for the fuel costs that we pay. So if we look here, again, if you look at kind of all the items of the, you know, all items together for the consumer price index, you look at food and then you look at energy, and then all items less food and energy, you can see that a lot of it is coming from the energy area. And in fact, if we break this down on the left-hand side, it shows you if you break it into the energy area, it's split between kind of two energy services and energy commodities. On the left, you can see fuel oil and gasoline, and if you can't see the chart, it's like 60% difference on a 12-month basis. And then on the right-hand side, it shows electricity and natural gas. So that's why we've got such huge numbers. And if you remember, during the crisis of 2020, oil actually went negative as a price, which was just the craziest thing you've ever seen in your life. And it was because, again, the contracts were coming up, and it meant that you actually had to have the oil delivered to you because nobody wanted to, nobody was going to buy it. And so people were literally, you know, it went negative. And so you had such a negative view of fuel or energy as a whole in 2020, whereas if you'd have closed your eyes and said, usually when people are running away from an area, that's usually the time to run towards it. And so energy's had a tremendous run back up. However, if you remember sort of when we were growing up, you know, we would have to rely on kind of OPEC and Russia for their oil, and we'd really be held ransom by them. And so the 1970s, you'd have kind of long fuel lines, and that's still in people's memories. Well, it's not the same anymore. You know, we're pretty much self-sufficient, and so it's about getting to the right price in oil, where kind of the US producers then start producing more, and in which case that kind of reduces the issue, because then there's more production. So for 2022, the US expects to produce a kind of a record amount of oil during this year, which means then that probably, you know, the prices won't hold as high because there's more supply and it'll come back. And so most consensus is that they don't believe that oil will stay as high as it is, or at least if it does, it's not going to increase from this point going forward at the same rate. So that'll probably, you know, come off, you know, a little bit. And then when we look at food, you can see that the difference of food at home and food away from home. So food at home has been more expensive. And if you dig into that a little bit deeper as well, you can see kind of where the expense is there. It's meats, poultry, fish, and eggs. And some of that is related to kind of the ability for the plants to keep operational with people in it and kind of keep going. And so that's played into it. And so that is why the Federal Reserve believes that kind of the inflation is more temporary, or the high inflation is more temporary. And as the supply chains kind of calm down, and as we get through kind of everything moving again properly, that it won't be kind of a perpetual increase at this rate, which we're very hopeful for. But again, that is kind of a negative that weighs on the economy and the markets going forward. And then incidentally, again, is that the food costs that I'd mentioned before, so the food spending just exploded over the last couple of years because it was very affordable for everybody. And I think that maybe there's somebody more than me buying a lot of Spam as well. So I don't know if anybody else likes Spam, but I've got extra to share. So we'll see. And the thought as well is that you'd also expect that very sadly, is that, as the stimulus payments kind of cease to people that needed a little extra in their wallet, that then there would be less food spending as well on that side. So there won't be as much as well. And then here, we're stuck again. There. I put this one in here, especially for Brock, because Brock loves beer. So I wanted to show him that from other things. So the alcoholic beverages, there is not very much inflation on those. So I thought that was a bit of happy news as well. Because whenever I see Brock on Facebook, he always has some exotic beer that he's got. But you can see as well is that used cars and trucks have been driven up, over 30% kind of difference from a year ago from the 12-month change. And that's again because of the chip shortage for cars. And so that's not something that's going to persist in the future forever. So you can expect that to come down as well. However, it's not a fast process to get kind of chip factories in place. I think that the one that was invested in for 2021 won't be online until 2024. So again, if there's an issue between China and Taiwan, that could also be a very significant issue there. But we'll see. And so you can see, so these going into the kind of the deep dive into CPI was really an intent to show you that some of this does really look transitory, and you can really better understand it and explain it. So, and then again, when we look at inflation and kind of why it matters is that because then the Federal Reserve starts acting against it because they say, oh gosh, well, things are getting overheated and the economy's, it's kind of unbridled growth. We're going to slow things down again so we don't have kind of crazy inflation. And so the expectation is that they will raise rates 3 times this year and possibly 4 times next year, and probably in the later part of the year as well. And so why that matters is that, again, it means that borrowing costs more and mortgage rates go up. And so then that starts dampening down things a little bit. However, it's not all, the market is a bit like a sulky teenager in that, when there are some surprises in there about, oh, rates are going to go up or a little bit more than they expected, kind of it sulks for a bit, but it's not truly, detrimental for kind of they adjust. So this fascinating chart, well, for me, shows you kind of that at what point, does the market not like it when rates start rising. So the gray line, so all the gray dots are what happened between 1965 and 2009, and the green ones kind of show kind of the interest rate movements and stock returns between 2009 and the present time. And so what happens is that right now the US Treasury, the 10-year US Treasury is at 1.74. During the kind of the brown gray time frame, that stocks and rates, so if rates went up, stocks were still going up until the yields rose to 4.5. And then in the green one, stocks and rates still moved up in the same direction until it got to 3.6%. So you can see that there is kind of a % or 2 difference in there that the Federal Reserve can raise rates before the stock market starts saying, okay, now it means that we're fearful and we're going to go in the opposite direction. So some inflation is not bad. The other part is that if you think about your cash levels, believe it or not, again, it was only in the kind of the 2000s where and when you looked at what cash levels were and what you get paid in your cash accounts, it used to be 4%. Financial advisors used to put in 4% as a cash return. And can you even imagine getting a 4% for cash? I mean, that would just be amazing. So however, if rates do go up somewhat, that is welcome in terms of kind of what you will then get to sit in cash or to have be in your fixed income portfolio as well. But one thing that most people don't realize is that when interest rates go up, bond prices go down, and you can see that a 10-year US Treasury. So if you were sitting with a 10-year US Treasury, you can see that if there's a 1% shift kind of rise in interest rates, then that portfolio drops, or that bond drops about 7.3%. So the expectation, so if you're sitting in a big bond portfolio because you think you're being conservative, then you want to rethink that because again, if interest rates rise, then you're going to have some downward pressure in the short term. Long term, it'll be great because then you'll get paid more, but short term, it will be painful. The other part is some geopolitical concerns for the year. If Russia invades Ukraine, it will be less of an issue in terms of kind of the market and economic outlook. But if the US's response to that is tepid or kind of fairly muted, then it may encourage again kind of the China-Taiwan issue as well, which would be a much more significant issue. Likelihood though is that the Premier Xi, he is, they are going kind of through a kind of a re-election time. And so the fact is that China's having its own issues with its economy, unemployment, and with the COVID issues that, we hope again that it's a fairly slim chance that will happen. But if it does, that would also put significant strain on kind of the market outlook. And then lastly as well, you can see as well that we still have unknowns for COVID to happen there. If everyone says, well, gosh, and I'm a little bit nervous about the stock market, so I'm going to throw all my money in real estate because you can't lose money there. This chart may kind of tempt you not to do that. You can see from a real estate valuation perspective, what this chart shows you is kind of the home price divided by the 10-year average median household income. So whenever the line is going up, it shows that it's expensive, that your home price relative to what your income is very priced. And obviously it's been encouraged by low interest rates, but you can see where we are now. And I put a red line there to show you that other than the kind of the 2000, kind of the run up to the 2008 time where you had a huge kind of real estate bubble, it's only ever been higher back in kind of the 1910s, kind of 1920s. So we are actually at a pretty high rate in terms of prices in real estate, which we all enjoy by kind of sitting on our houses, but it's still really expensive as well. And then the last thing I thought I would cover, and I'd have a kind of a lot more, I had some charts later in case we had time, but I also get a lot of questions on Bitcoin and should I be investing in Bitcoin? And kind of our view is, if you like riding bucking broncos, then maybe it might be for you. But if you if you like to keep your feet on the ground, perhaps not. It's not particularly it's not asset backed. So it's kind of hot air behind it. And if you have a look at kind of the rise and fall of it, take a look at again what happened kind of 2021, 22. It's had a pretty precipitous fall. it's all fun at the party until governments start to get involved and don't appreciate it, and it will. And at any point, if it ever kind of came into true competition with currency, then it would be clamped down faster than you would know it. But South Korea has banned it. China has clamped down on it. And then, interestingly enough, there are a lot of countries that are actually starting to develop their own digital currency. And because it's in their interest to be able to really be able to control that. So our view is that we all have friends who've gone to Vegas that have come back and talked about a big win there. And we're happy for them, but we don't generally kind of think that that's probably a good idea. And it's the same thing here. You want to be very, very careful. And again, because it's all held electronically. There are frequent stories about people, like somebody might have an interest and then they pass away and they haven't actually told somebody they have a wallet with anything in it, and then it all goes. It's quite dangerous. And so our view is that if you look at kind of the head of JP Morgan and Warren Buffett, I mean, their personal views are not a great idea. So our view again is it's very much like going to Vegas. If you want to have a little bit of fun, but if you don't mind if something goes to zero, then have a good time. But that's not generally what you want to do with your retirement money. And then lastly, it was, may the only negative things in 2022 for you be your COVID test. But on the whole, our view is 2022 should be a reasonably positive year, slower economic growth, slower market returns than probably 2021. But there are still dangers out there, which hopefully will be muted. But it should still be reasonable. There you go.
Want to buy a used car? How long do I have to wait?
How long would you have to wait? Well, hopefully, probably a year. So it's not a fast process. We'll just see. We'll see whether the consumers just start slowing down, kind of their buying as a whole. Because I mean, the issue is that everybody wanted to kind of start shifting around at the same time. So we'll see. As I said, the real danger is if there was any true issue between China and Taiwan, that would be a major, major issue. So we'll see. But unfortunately, again, it takes so long to get things, to ramp things up. It takes a couple of years for factories to be operational. So I plan to keep driving my car for a while. And COVID, we haven't had to drive them very much at all. So we'll see.
In honor of you speaking here today, we ask you to sign this book. It goes to our Way to Grow program, which provides books to third graders that are signed by leaders in our community. And
Thank you.
The bookmark that is yours to keep.
Oh, adorable. Thank you.
Yeah, so if you could sign that.
Thank you.
While you sign that, I'm going to close us out. Thank you all for being here today. Next week, we are going virtual only. So virtual only next week. Do not come here. We'll be virtual only, and we will hear from Braver Angels. That should be a very interesting program. So join us online next week. No live meeting. We'll be going week to week to let you know if we're going to come back to a hybrid meeting. We hope that the COVID rates start declining, so we'll be able to come back here hopefully on the 26th for the mayor, but we will see what happens with the COVID rates, et cetera. But we'll keep you well apprised of that. I want to thank Kelly for being our day chair today. Of course, Brock and Ross for your good help, Sean Irwin for doing our reflection, and the Rooters for the song. You all have a great Rotary week. Thank you so much.